In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about how Indian banks are doing with reference to a new report by the RBI. And in the second story of the day, I'll talk about an interesting link between credit growth and economic growth. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 31st of December. Let's begin with the first story. See, the Reserve Bank of India recently released its Trend and Progress of Banking in India 2023-2024 report. Now, if you're wondering why this exactly matters to someone like you, banks are basically where money flows in as deposits, and they are also the source from which our loans pour out to fuel everything from businesses to our personal dreams. Now, when banks do well, the economy also does well. But when they falter, the ripple effects are hard to ignore for us as investors. So the question is, what is exactly happening with Indian banks right now? Let me break it down piece by piece and start with the basics for you. Now, the first thing to know here is that deposits and loans are two of the most critical numbers to watch out in banking. Deposits, for your reference, are basically the money that people and businesses park in banks, while advances are the loans that banks give out. Both, in a manner of speaking, are lifelines for our economy. Now, in the financial year of 2023-2024, deposits grew by 13.4%, while advances expanded by an even larger number of about 16%. Now, this means that banks lent money at a faster rate than they collected it, which is a sign of an economy that is hungry for credit. But the thing is, this has narrowed the gap between credit growth and deposit growth to just 3.4 percentage points. And this signals tighter competition for funds now. But I'll tell you where things get a little interesting. See, while deposits still form a bulk of a bank's liabilities, their share has slightly declined. Borrowings, on the other hand, have picked up. They have increased from about 8% to 9% of liabilities. Now, you might ask, why is this happening? See, it's partly because banks are chasing higher profits. Lending money earns them more than parking funds in government securities, which are safe, but they offer lower returns in comparison. Loans and advances now make up about 61% of total bank assets, while investments in government bonds have fallen to about 26%. Now, this, in a manner of speaking, is a calculated risk because more loans obviously means more income, but on the other side, it increases a bank's vulnerability to bad loans in case borrowers start to default. Now, in case of Indian banks, their profitability has grown for 6 straight years now. In the year 2023-2024, two key measures of efficiency, which is return on assets or ROA and return on equity or ROE, has improved to 1.4% and 14.6% respectively. Now, to some people, these numbers might look relatively small, but in the case of the banking world, they reflect some significant gains. Now, at the same time, banks have faced rising costs as well. The cost of funds, which is the average interest that banks pay to gather money from depositors and lenders, has jumped by about 104 basis points to 5.1%. Private banks have felt this pinch a little more because their costs have risen to 5.4 as compared to 5.0 for public sector banks. And if you look at small finance banks, which for your reference operate in relatively niche markets, they saw highest costs at about 7%. But all said and done, private banks managed to maintain a very comfortable lead in terms of profitability. Their spread, which basically is the difference between what they earn on loans and what they pay on deposits, was at 4.1%, which was far higher than the 2.9% spread of public sector banks. Now, this gap shows us that the private sector is now focusing on high-yield lending, like personal loans and unsecured loans. And the reason for this is because these kind of loans bring in higher returns, but the thing is, they also come with some greater risks. But the best part was that one of the standout achievements for Indian banks this year was a sharp reduction in bad loans. See, gross non-performing assets or NPAs, which are loans that borrowers fail to repay, dropped to about 2.7%, which is the lowest in the last 13 years. And if you take a look at net NPAs, which accounts for provisions already set aside for bad loans, they hit a decade low of 0.62%. Now, you might ask me, how did this exactly happen? See, banks got really serious about recovering their dues during this time. They used multiple strategies over here. First, they used the Surface I Act, which allows banks to seize and sell assets that borrowers have pledged as collateral. Now, this method is pretty quick and also effective for smaller loans which are backed by assets like property. The second thing they resorted to was the Insolvency and Bankruptcy Code, or the IBC. Now, this focuses on large and complex cases. And over here, companies that are in financial trouble are restructured or even completely liquidated through legal tribunals. Now, while this process can be relatively slow, it has been pretty instrumental in recovering nearly 28.3% of the total amount involved in insolvency cases. The third thing that banks have done is using sales to asset reconstruction companies. Now, these basically allow banks to sell bad loans to specialized firms which attempt to recover the money. Now, even though this method accounted for only about 5.8% of the recoveries this particular year, it is still a very, very important tool for clearing bad loans off their books. Now, altogether, these three mechanisms have helped banks clear up their balance sheet and have freed up resources for fresh lending. And while we're talking about lending, know that banks' lending patterns also reveal a lot about our economy. Retail loans, which are personal loans, home loans, vehicle financing, etc., saw a great amount of growth, which reflects strong consumer demand. Credit to micro, small, and medium enterprises, which are also called MSMEs, also grew significantly, which was aided by government schemes like the Emergency Credit Line Guarantee Scheme, or the ECLGS. But that said, not all sectors are doing equally well here. Agriculture loans, for example, grew pretty modestly, and the sector continues to struggle with high NPAs. About 8.5% of total loans to agriculture still remain unpaid. Infrastructure and power sectors, while stable relatively, are still struggling with legacy issues, which include high levels of bad loans. And this paints a pretty mixed picture for all of us. Credit is definitely flowing freely into high growth areas like retail and MSMEs, but old challenges in sectors like agriculture and infrastructure still continue to persist. So yes, the Indian banking system is stronger today than it has been in the last few years. Profits are rising, bad loans are following, and efficiency metrics are improving for sure. But the thing is, the risk still cannot be ignored. Banks are taking on much more borrowings, which could eventually squeeze their margins over time. They are also betting heavily on lending, which makes them a lot more vulnerable to defaults if the economy ends up slowing down. So all in all, it's a pretty delicate balance. On one hand, the banking sector's performance shows a healthy appetite for growth, but on the other hand, it is a reminder that growth always comes at a cost. In the next story, let's talk about the relation between the growth of credit and the economy. See, there's something very fascinating about the way credit interacts with economic growth. It's not just about how much credit is floating around in the system, it is actually about how effectively it is used overall. Now, a recent report by the RBI got a little deep into this delicate balance and brought up some very interesting insights. So in this story today, let me break them down step by step because they are pretty interesting for us as investors and for people who track the markets. Now, the core idea behind all of this is that credit fuels economic growth, but only up to a certain point. Beyond that, it can lead more harm than it can do good. Now, this insight is based on the analysis of data from 16 countries, and it shows a pretty interesting pattern. As the credit to GDP ratio increases, it creates a virtuous cycle at first. Businesses borrow to invest in new projects, households take loans to spend money on homes and goods, and the economy ends up growing faster. But there's a catch here. See, this growth is not unlimited if you think about it. The relationship between credit and GDP growth follow what's called an inverted U pattern. Now imagine a curve that rises steadily, reaches a peak and then starts to decline. Now the peak of this particular curve is where credit growth is most productive, which is where it adds most to our economy. Now, according to the study that I'm referring to, the sweet spot for credit lies at the credit to GDP ratio of 113%. Now, beyond this point, the benefits start to diminish. And that is because credit then begins to flow into less productive or even risky activities like speculative investments and eventually slows down the economy instead of speeding it up. And I'll tell you why this is particularly interesting for our country, India. See, our credit to GDP ratio currently is at 90%, which is well below the 113% threshold. Now, on paper, this says that there is a lot of room for credit expansion to drive more growth. But, and by the way, this is a big but, we cannot take the 113 figure as an absolute rule. You might ask me why? See, that is because this particular number of 113 comes from a relatively smaller set of countries and their financial systems are very, very different from ours in India. To give you an instance, India has large informal credit markets, significant regional disparities, and varying levels of financial literacy. Now, all of these factors make it very tricky to directly apply this threshold to our economy. But what matters more to us is the principle. Credit, when used wisely, can be a very powerful driver of growth. So let's zoom in on why credit is so important. Let's take agriculture as an example. See, for millions of farmers, access to credit can mean the difference between just surviving and actually thriving pretty well. A study in eastern India found that farmers who borrowed money, both from banks and informal sources like friends or money lenders, earned more from their farms as compared to those who did not borrow money at all. Now, on an average, their incomes increased by anywhere between 3% to 24%. And the biggest gains came when they used a mix of formal, which is bank, and informal loans. You might ask why again? See, because having access to funds allowed them to invest in tools, seeds, fertilizers, and all the other resources which required them to increase productivity. Informal loans usually come at a very steep cost, interest rates that can be as high as 27% per year compared to the much lower 12% that is charged by banks. Now, unfortunately, about half of India's agricultural households still heavily rely on informal credit, which heavily eats into their profits and keeps them stuck in a vicious cycle of debt. Now, if more farmers had access to cheaper formal loans, it could definitely transform urban economies. And credit here just does not help individuals, it is also a big game changer for businesses. If you take micro, small and medium enterprises or MSMEs as an example, they contribute about 30% to India's GDP. And despite their importance, these businesses have a massive credit gap which is estimated to be around 20 to 25 lakh crore rupees. Now, bridging this gap itself could unlock tremendous economic potential for us. And even global research shows that when people have better access to credit, they are a little more likely to start their businesses, create jobs, and earn higher incomes. Now, for instance, in the US, individuals with improved access to credit after bankruptcy were about 33% more likely to start capital-intensive businesses. Now, these ventures did not just succeed, they also helped with job creation and increased entrepreneurs' earnings by about 4% on an average. And let me tell you, credit benefits do not even stop at income or business growth. It also helps families against uncertainties to a great degree. Now, a survey from 2018 showed that households with access to formal credit were about 21% more likely to invest in education and healthcare. Families that borrowed for education usually ended up seeing their children's future earnings rise by about 15 to 20% thanks to better schooling and better opportunities as a result of that. But all said and done, the picture is not entirely rosy. Around 190 million Indians are still unbanked, and 50% of rural households still depend on informal credit, like I mentioned before. So all of this limits their ability to improve their lives and escape poverty altogether. And when credit is mismanaged, the consequences can be massive. The 2010 Andhra Pradesh microfinance crisis is a great reminder for this. Excessive lending at that point in time had led to widespread defaults. The government's crackdown on microfinance institutions then cut off access to credit, which led to falling rural wages, reduced consumption, and struggling small businesses. So if you ask me what the takeaway here is, see, credit is undoubtedly a very powerful tool for growth, but its effectiveness depends on how and where it is used. For India, ideally speaking, the focus should be on two things. First, we need to expand our access to formal credit, especially in sectors like agriculture and MSMEs where it can have the most amount of impact. And second, we need to ensure responsible lending practices in order to avoid overextending credit into unproductive or risky areas. Because at the end of the day, it is not just about chasing an arbitrary credit to GDP number like the 113% I spoke about. It's actually about using credit strategically to drive sustainable and inclusive growth in the country. By the way, that said, India has made some significant moves in the right direction here. Initiatives like the Pradhan Mantri Jan Dhan Yojana have brought millions and millions of people into the formal banking system, and schemes like the Kisan Credit Card are now making affordable loans available to farmers. But still, there is still a long way to go for us. With that, let's move on to the final section of the day and talk about the quick news tidbits. First, Adani Enterprises is now fully exiting Adani Wilmar by selling its 44% stake in two phases. Wilmar's subsidiary will buy 31.06% at up to 305 rupees per share, with another 13% sold to meet public shareholding rules. Adani is planning to reinvest in core businesses like energy and transport. After this particular announcement, Adani Enterprises shares rose by about 7.65% and Adani Wilmar stock saw some amount of volatility. Second, Public sector bank workforce fell to about 7,56,000 in FY 2024, which is the lowest in 13 years. It is down 12% from FY 2017. Mergers like Dena and Vijaya Bank into Bank of Baroda, slower branch expansions, and declining clerical roles have driven this drop significantly. On the other hand, private banks have doubled their workforce to about 8,46,000 during this time period because they have attracted better talent with better pay and rapid growth. Third, JSW Group is in talks with Chinese firms in order to strengthen its EV strategy. They want to bring advanced tech and cost efficiencies. This partnership is aimed at positioning JSW as a very strong contender in India's growing EV market, which is driven by rising demand and supportive policies. And this collaboration could heavily reshape JSW's role in green mobility and boost investor interest as well. That's all the news and stories I have for you today. I hope you found value in this episode and maybe learned something new from it today. As usual, this is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.